Hello students, my name is Shesi George, your professional accounting teacher. Before you continue with this video, please try to subscribe to my YouTube channel. Thank you. Alright, let's get started. In this video, we are looking at the concept of absorption and marginal costing system, a case study. Okay? Now, I want you to pause this video and read through this question. Thank you for that. Okay? Now, in this question, you have been given the budgeted information of a particular manufacturing company that manufactures photocopier. All right? For the last 2 years was given as follows. You are given the budgeted information. These are the budgeted information is given. Then the actual results for the last 2 years is also given, year 1 and year 2. It's also given the direct costs, the variable production overhead, the fixed overhead. That's the annual fixed overhead. Then you have to prepare the actual profits and loss statement for each of the 2 years using absorption costing and marginal costing. Then you have to calculate the budgeted break-even point in units and the budgeted margin of safety as percentage of the sales for year 1 and then again for year 2. Then provide a reconciliation of the profit of absorption costing with that of marginal costing. Okay, so let's quickly get started. The first thing to do is to some preliminary working notes. Okay, you have to carry out some preliminary working notes. Our working note 1, therefore, when you are solving absorption costing, is to determine the calculation of OAR, and the formula for OAR is nothing but budgeted overheads divided by budgeted level of activity. All right, level of activity. Then make sure you are using for the numerator. This is the numerator, is the same base with the denominator. What do I mean is that if the numerator is annual, then the denominator must also be annual. So students should take note of that. So in this case, budgeted. So let's go to the budgeted information. We have fixed production overheads. So the fixed production overheads is the annual, but if you look at all these selling prices per unit, all these ones are per unit, per photocopier, but for this is given, and it's the same thing with year 2. It's the same thing with year 2. Then annual production units is 70. All right, so we need to divide this with this. So we now come here and write fixed overhead absorption rate is nothing but 525, the budgeted, divided by 70, and this will give you from your calculator 7,500 per unit, that is per photocopier. All right, then the next working note is to determine our standard cost. That's calculation of standard costs. When we talk of standard, per unit, standard cost per unit, students should take note of that. All right, you follow the step. Okay, that's the Georgian step. Calculation of OAR, which you have done. Calculation of the standard costs per unit. Okay, then we are to calculate for year 1 and year 2. All right, so for year 1 and for year 2. So for year 1, we have standard costs per unit. What is our standard costs? So we have this is the selling price. The standard costs is given, that is 20. The variable production overhead is given. The direct costs as 11. All right, so we have direct costs is given to be 11 No, 20,000. For year 2 is also 20,000. Also, we have our variable production overheads. Per unit is 11 and 12, okay? 11,000, then 12,000 is given. Then when you add this together, it's going to give you your marginal cost. This is 31,000 and this is 32,000. That's our marginal cost. Because the question says we should use absorption costing and marginal costing. So you would have gotten this for now. Then you have your fixed production overheads, which is your OAR. That's your working note 1. All right. So we have per unit 7.5, per unit 7.5 is the same. Then you add. What do you add? We have 38,500. So these are full costs of production. That is 39,500. So this is the full production cost per unit. Full production costs per unit. Then the next, this is working note 2. Don't forget, working note 3. Working note 3 is nothing but over and under absorption adjustments. Adjustments, okay, over or under absorption was adjustment. Now, for year 1 and for year 2. So we have number 1, absorbed overheads. Your absorbed overheads. All right. And what is your absorbed overhead? Absorbed overhead is nothing but OAR multiplied by the OAR. The OAR is 7.5 multiplied by the actual level of activity. And your actual level of activity from this question is 40 for production. Actual production unit is 40. Actual level of activity. And that is 40. Okay. And that gives, when you multiply 40 by that number, it's going to give you 300,000. All right. Then for year 2, we have 7.5 multiplied by 60. 7.5 multiplied by 60. Okay, that's your actual level of activity from the question. All right. So we have multiplied by 60, and that gives for year 2. This will give 60 times this from your calculator, it gives 450. That's our absorbed overhead. Now we now have actual overheads. That's fixed production overhead incurred. What's the actual overhead incurred? The actual overhead is 500,000 and 530 respectively for year 1 and year 2. So we have 500,000. Then this is 530 for year 2. Okay. Now you look at this formula. When you start with absorbed minus actual. If your answer is negative, so of course it's negative here, that is under absorbed. So we have under absorbed. Then it's also negative here. So when you subtract this, what do you have here? We have 80,000 under absorbed. All right. So under absorption. But if your answer is positive, it means that is over absorption. over absorbed. This is what you have actually charged, but look at the actual overhead incurred. So you must have gotten this in your working note 3. All right, okay. Now, having done that, we can also compute our stock, valuation of stock. That is working note 4. That is valuation of closing stock. Valuation of closing stock. Valuation of closing stock. Okay, valuation of closing stock. All right, now in this case, for valuation of closing stock, your annual sales is 30, your annual production is 10. All right, it's 10, it's 40. So the closing stock, if you produce 40 and you sold 30, the demand is 30. So the closing stock here is 10 for year 1. So for year 1, we have 40 minus 30 multiplied by, since it is absorption costing, at full cost of production, at full cost, so times 38,500, and this will give you, so when you press your calculator, 385,000 naira. All right, to give you 300. Then for year 2, all right, how do you calculate your closing stock? We know that our opening stock is 10. All right, when you add production, that is plus what you produce 60 units. Okay, 60 units is produced and 60 units is sold. Okay, and that is 10. It will give you 10. Then multiplied by at full cost. At full cost, because this is absorption costing. Absorption costing at full cost. So we have 89,500. And this will give you nothing but 895,000 naira. Okay, I will repeat this. The closing stock here will come as opening stock. Okay, we come as opening stock. Then you produce 60, you sold 60. So the closing stock still remain 10. So if you use your calculator, it remains 10. But in year 1, you produce 40, you sold 30. Okay, so what remains at the end of the year? What? 10. Now, for year 2, this is year 2, the closing stock becomes the opening stock. All right, the closing stock of year 1 becomes the opening stock. I produce 60, I sold 60. So I will still have my closing stock to be 10. All right, so students should take note of that. So these are the 4 working notes. Then we can now prepare our actual profits. Okay, we can now prepare our statements here. So we can start with our sales. All right, so how many do we sell? We sold 30 in year 1 and sold 60 in year 2. And the standard selling price for each photocopier is 50. So 50 multiplied by 30. So we can also include that in our work. So for year 1, our sales is nothing but 30. That is, we sold 30. We sold in year 2, we sold 60. Don't forget. So that's 30 multiplied by the selling price for each is 50,000, which is the same thing as the standard selling price, and that is nothing but 1,500,000. Then for year 1, that's for year 2, we sold 60 multiplied by 50,000 units, and that is nothing but 3 million. Okay, so once this has been ascertained, Then we come to our major work. So for year 1, we have 1.5. So this is working note 5. Then for year 2 is 3 million. Okay, 3 million. Then don't forget profits. What is profit? Profit is nothing but sales minus cost. All right. Then you now start with cost. Don't forget using absorption costing. Using absorption costing. So what do we have here? We have our costs of sales. So we have our direct cost. But before the direct cost, using absorption costing, we have opening stock. Don't forget opening stock. There is no opening stock in year 1. No opening stock. But we have direct costs. Our direct costs. So what's the direct cost for year 1? The direct cost for year 1 is to multiply. Are you with me? Is to multiply this 20 multiplied by the production, which is 40. So 20 multiplied by 40, and that gives 800,000. For year 2, it gives 120,000. That's 1.2. Okay, 1.2. So we have our production units, annual production units, each multiplied by the direct cost, 2020. You multiply. All right. You also multiply the variable production overheads, which is 11,000 multiplied by 40, 12,000 multiplied by 12. Okay. So we have variable production overheads. So when you multiply 11,000 multiplied by 40, and that gives 440. Then 12,000. So for year 2 is 12,000. Take note of that. For year 2 is 12,000. So you multiply by 60. That's 720,000. Okay. 720,000. All right. Then don't forget our fixed production overhead absorbed. So our fixed production overhead absorbed. So what do you do? Fixed production overhead. You multiply 750. Fixed production overhead absorbed, which is 300. 7,500 multiplied by 40. 7,500 multiplied by 40, which is 300. 7,500 multiplied by the actual production units, which is 450. So, and that gives 300, and this gives 450. Okay. Then you have your total production cost. This is total production cost or full production cost. So when you add this together, that is 800 plus 440 plus 300 plus 300,000, and that gives 1,540. 1,540,000. All right, 1,540,000. Then you less closing stock. That's our working note 4. Our closing stock. So the closing stock is valuation of closing stock. It has been valued at 385,000 minus closing stock. That's working note 4. So when you go to your working note 4, we have 385,000. Don't forget, this is absorption costing. The closing stock is absorbed. at full cost. It's calculated, it's valued at full cost. So when you subtract this, then what do you have? We have 1,155,000. All right. So you need to subtract this, and this gives us the standard profits. All right. So it's going to give us the standard profits. It's going to give us the standard profits of. So when you subtract 3, 4, 5,000. All right. Now, the standard profit, if it is given, then you subtract adjustments for over. That's under absorbed. Under absorbed. So what's your under absorbed? Under absorbed for year 1. The under absorbed here is 200,000. So you need to less the under absorbed, which is 200,000. Is less. Then this one will give you the actual profits. Actual profit. So what's the actual profit? We have 145,000. 145,000. Okay. Now for year 2, our closing stock, don't forget, comes as opening stock, and it has been valued at full cost. It has been valued at full cost. Okay. And the total year is 2,370,000. Then what is the value of closing stock at full cost from our working note 4? The value of closing stock is 3,950. 3,950. Okay. 3,950. That's 395,000. And this gives a total of when you subtract, it gives a total of 640,000. Then the standard profit. What's the standard profits? The standard profits. Sorry, this gives 2. Sorry for that. This gives 2,360,000. 2,360,000. Sorry for this naughty mistake. 2,360,000. When you subtract this from this, it gives 2,360,000, and the standard profit is nothing but 640,000. Please, students, should pardon me for this. Then the under absorbed from our working note 3 for year 2 is 80. It has been calculated 80,000. All right. Then you come back, you have your 80,000 under absorbed. All right. So when you subtract this, your final profit is 560. And that's close the case. That is actual profits. That's the actual profits. All right. So I will stop here. The actual profit and loss statement for year 2, using for year 1 and 2 using marginal costing will be done in the next video. Thank you. So if you understand this video, please remember to share with your friends. Do share with your friends. Bye for now.